everybody, welcome back. So in today's video, we're going to be talking about a universal life insurance policy. Universal life insurance is a permanent type of life insurance with an investment savings element. It often has low premiums like term insurance does. Most universal life insurance policies contain a flexible premium option. However, some are going to require either a single premium or a fixed premium option. The premiums in these types of policies consist of two components: the cost of insurance and then the savings component known as cash value. These products do have the option to pay above the minimum required to cover the insurance. The additional premium that you pay into the policy is invested and grows cash deferred for future cash value down the road. You can typically shift the money between the insurance component and the saving component if you choose to. The premiums can also be paid by the accumulated cash value. So let's just say, for example, John purchases a universal life insurance policy. He's required to pay $50 a month, but he also wants to put some extra away for savings as well. So he's going to decide to pay an additional $50 a month. The older that John gets, the cost of insurance is going to rise with that. So less of his $100 is going to be going into that savings element. Now let's say after several years, he decides to use the savings element to pay for the premiums. In a few years, he can take the cash value to pay the premiums in his policy if he chooses to. Interest rates in universal life insurance policies can vary from month to month and typically are not very high, meaning other investments might offer you greater returns. The downside of a universal life insurance policy is that interest rate. If the policy is performing well, then there's chances of potential growth in that cash value. On the other hand, if that policy is performing badly, the estimated returns are not earned. So you're going to end up paying higher premiums to get the cash value in your account going. Universal policies will likely take the cost of insurance from the cash value if the premium payment is ever missed for any reason. Now, if the policy slips below zero or there's not enough funds in the policy to pay the cost of insurance, your policy is going to lapse and you're going to be forced to pay higher premiums to keep it enforced. Now, let's say that your death benefit in that policy is $100,000 and you are able to borrow, say for example, $50,000 out from the cash value. If you die before that $50,000 is repaid back into the policy, your beneficiary is only going to get the remaining $50,000. They're not going to get the full $100,000 because you took out $50,000 as a loan. Those loans will always be deducted from your death benefit if it's not returned back to the policy. So this was just an overview of a generic universal life insurance policy. Every policy is going to be different, so make sure that you understand what your exclusions and policy details entail for you. If you think that a universal life insurance policy makes the most sense for you, reach out to me today. I'm more than happy to go over some options for you guys. Thanks so much and come back soon.